So I think we can wait a couple more minutes before beginning. So I think we can start. Hey folks, good morning to you all joining us from around the world for PyCon India, PyCon Hyderabad 2020. I am Aditya Loya. I will be the host for this session. I have with me Dr. Yves, Hilpisch, and Jason. So I'll be introducing them first. Dr. Yves Hilpisch is a founder and CEO of the Python Cons, a group focusing on the use of open source technologies for financial data science, artificial intelligence, algorithmic training, and computational finance. He is also the founder and CEO of the AI Machine, a company focused on AI-powered algorithmic trading based on a proprietary strategy execution platform. He has a diploma in business administration with distinction, a PhD in mathematical finance, magna cum laude, and is an adjunct professor for computational science. Jason has worked at Refinitiv Thomson Reuters for 7 years as a developer advocate, helping to build our developer community. Previously has worked in financial markets for over 15 years with a quant background in equity and equity-linked space at Jefferies LLC, Sakura Finance, and Oxen Securities. So, the attendees attending this talk, this tutorial, can ask their question answers in the Q&A tab that will be visible to your right as well as in the feed. So we'll be asking questions at the end of the session based on the upvotes in the Q&A tab. Also, there's a raise hand feature for you guys, for you folks, wherein you can raise your hands if we have time remaining, and Yves and Jason can answer your questions once you are pulled into the live conference. So I think you can begin, Yves. I hand it over to you.
All right, thanks very much for the nice introduction. Welcome everybody to our talk here about financial tick data analysis with Pandas. Actually, we're going to do a little bit more. We also will have some machine learning AI applications to work with the data. So it's not only about data processing. I'm happy to give this talk in cooperation with Jason from Refinitiv, and upfront the data that we're going to use and that you will have access to is sponsored by Refinitiv. So we have quite a bit of data to work with. But before we get to the data and the coding itself, first a quick introduction. What we do, so the Python quants, I don't want to talk that much about it. You simply can visit our webpage, tpq.io. It's all about Python for finance in a broader sense, so training, certifications, open source technologies, platforms, books, etc. Have a look at the webpage. We also have developed a algo trading platform, the AI Machine, which we use currently internally. Now we are onboarding the first external users to the platform. All about algo trading and standardized deployment of strategies in the cloud. Here also a few links that you can go through if you're interested in background, in particular with regard to our university certificate in algo trading. I've written a bunch of books, so it all started for me with quant finance. That's my background, my PhD in mathematical finance, and where Python plays the role of embodying, implementing the models in a modern language. And it moved forwards to other topics, actually, and it started in this context with Python for Finance, which covers with the second edition like a much broader set of topics. So basic stuff for Python in finance, also advanced topics such as computational finance, as we have seen before, or algorithmic trading, also topics such as efficient I/O and performance Python. From all the books I've written, this is the bestseller. It's not a Harry Potter, but I think this is the one that is used these days around the globe at universities, at companies, and in other places. And I have published just now 2 more, Python for algorithmic trading, from idea to cloud deployment. These are the resources that we use since a bunch of years now for teaching Python for algorithmic trading. And artificial intelligence in finance goes a little bit deeper with regard to the prediction part. And that's also an outgrowth of our teachings over the years and of our practical experiences in the field. So coming to the agenda, first a few words about data-driven finance. So it's actually the area that we are in, where we talk about financial big data analysis, etc. So when I studied finance, going back some 25 years plus a little bit even, this was all about theoretical models, and you picked up the books and you tried to master the math, and there were topics like capital asset pricing model, contingent claim pricing, and all these theories, arbitrage pricing theory, etc. But this has shifted a bit, so theory has not, let's say, priority, because data is available, and with new technologies, you can make a little bit more out of the data these days than was possible 10, 15, 20 years ago, or even 50 years ago, when it all started with the first quant models. We then talk about the tick data. I will then hand over to Jason. He gives quite a bit of background, interesting background about what Refinitiv has to offer. We then show how to process the data, so you will have access to the data. A few words about efficient markets, and then our try to overcome the curse of efficient markets for algo trading by the application of AI, machine learning, or maybe in other contexts also reinforcement learning. So that's the plan for today. Data-driven finance first. We all know about where we are coming from. So let's say in the 20s, 30s, 40s, 50s, 60s, 70s, there were just like newspapers around where people got their news from. It just started not so far ago that people got access to data in electronic fashion. So today, I mean, I access Financial Times. I have also a subscription to the Wall Street Journal. It's all online for me and for many others as well. So I hardly read printed material anymore these days. But what people do since decades, we can almost say, is that in the financial industry, when they have a professional role, they access data in a central fashion, centralized electronic fashion. So here you see the recent addition to the tools of Refinitiv Workspace. When I say, well, I'm interested in the Apple stock, I don't need to sift through, I don't know, thousands of pages to get an overview of what Apple is all about these days, or at a certain point in time. I just call up Apple here on the screen. I see news, I see background, I see prices, I see estimates, I see fundamentals, and all in a single place, right? So I don't need to go through to a newspaper or a magazine like Barron's or whatnot to learn about Apple. This is all available in centralized fashion. This is what we usually see when the traders have like their 8 screens in front of them, and at least parts of these are like these terminals, such as Workspace here from Refinitiv. But not even that I would call data-driven finance, because this is still like you have a look with your eyes on the screen and need to do your stuff. So when data is the driving factor, it's usually in the context of programming, where you say, well, I have a language such as Python, of course, at the Python conference, and this is what I do exclusively almost. Have a powerful programming language, and companies such as Refinitiv provide powerful APIs. And when I'm interested in tick data, I don't need to open like a terminal and have a look at like thousands and thousands or hundreds of thousands of tick data points. I can simply retrieve the data from such an API. And it's there, and for the machine, it doesn't really matter whether it's like 200,000 data rows or 200 million or even 2 billion data rows. So modern machines, even when you have like a regular notebook or a regular desktop these days, they can cope with financial tick data in general quite efficiently, right? And this is what I would call data-driven finance. When you think back where all the theories in finance originated, like in the 50s, there was, if at all, end-of-day data, and usually it was kind of like very limited, and people needed even to do back then their regression with pen and paper, right? So we have come a long, long way, and instead of brainy people coming up with nice financial theories based on modern math, we now have the data that we can analyze. And this holds also true for unstructured data. When you think of like reading the newspapers, today the machines are reading the newspapers as well. Again, via APIs, where you get like the recent articles that are published. Roughly 1.5 million articles, news articles, are published on a daily basis and are absorbed by the likes of Refinitiv and provided via APIs with additional tags and meta information to make it more easy for the machines to read it, right? So who, as a human being, can read 1,000 articles daily? Let's say a machine can read, if it needs to, like 100,000 articles, and can come up with summaries, sentiments, etc. What can be done these days, and it's much more in the NLP sector than was available and possible before. So why is this so important? Yeah, because we have seen in other areas such as language, natural language processing, which was what I was talking about before, that for certain use cases simply need lots and lots and lots of data, right? And for NLP, this has proven so useful. And when you these days read about GPT-2, GPT-3, and they are crunching like billions and billions of pages from the web to train these models. So big data really is the key. And in finance, maybe that's the key as well. Maybe finance is more like natural language, like a natural language, let's say English, like our at least common denominator, than it is close to science, to physics, right? In physics, it's nice when you have like these formulas that everybody knows about, even if they have nothing to do with physics, such as from Einstein's E equals mc squared, right? Everybody knows that. There's even like memes, like you see even on the walls, sprayed on the walls. And in finance, it might be the same thing, right? Maybe data is the key to better understand the markets and to better cope with today's market. So that's, I think, the important aspect here, that more data might be indeed better. So more is more and more is better in this context. With Python, we have like a wonderful ecosystem which allows us to efficiently crunch it, also in a scalable manner these days. So when you think in terms of even consumer GPUs that you can use, for example, for faster machine learning, and also the working memory that's available actually at cheap prices, fast CPUs like the new Apple M1, let's say. So major breakthroughs, and our Python gets better and better by the day, given the hardware and the developments and updates on the open source side as well. I mean, open source important. We don't need even to pay for all the nice tools and the packages that we use in this context. Here, with this as background, getting to the financial tick data, I just have a screenshot. And for me, this means that I will hand over to Jason, who will give you some more background for the data and also about Refinitiv and what's available these days in terms of data. And then we will pick up again and get started processing the data. I have actually posted the link to the resources, the codes, and link to the data, as well as link to the slide deck in the feed. So have a look at the feed here, and you find 2 links with all what you need for our session. So I stop sharing and can hand over, or Jason can take over.
Great. Can you see my screen?
Yeah, looks good.
Yeah. Okay. Hi, everybody. Thanks very much for your time. I'm Jason Ramchandani from Refinitiv, and just going to talk to you a bit about tick data. So we're experts in extracting insight from very large sets of data. We've got 60 petabytes of data stored, which is 11.8 million time series, loads of company events, 42 million estimates for all companies around the world and KPIs, 13.4 million fixed income securities, 57,000 public companies, 520,000 equity quotes from over 295 exchanges, research documents, news. We provide financial price updates. Actually, this is slightly old. 8 million is probably from about a year and a half ago. We regularly have over 16 million financial price updates going through our real-time full tick network. So let's. So we have plenty of data. We have news from over 10,000 sources. So we have in a world of data-driven finance, we obviously have quite an interesting offering. I think. I hope to show you that as well. So what are the characteristics of tick data? So it's the high frequency, lowest latency data available. This generates very, very large volumes of data. And there are generally two types of tick data: level one, or top of the book, which provides the best bid and ask. And then you have level two, or the full order book, which offers up to 25 levels of market depth on the bid side and the ask side. So the tick data is irregularly spaced time series, as opposed to, say, 1 minute kind of bars. So you have a lot of discrete price movements. We see phenomena such as errors, gaps, and corrections sometimes in those things. So you need to handle all of those. So it's a little bit more complex than handling standardized bar data that you may be used to. So the main use cases for this type of data are algo trading, which is the use case that we'll be discussing today, the generalized quant research, compliance, and transaction cost analysis. Also, most tick data series kind of display clustering tendencies, and we'll see some of that. I'll show you some of that in a second. So Refinitiv Tick History is our product which does that. So we provide a full historical archive of the full tick network, delivering upwards of 16 million updates a second. So we have about 6 petabytes of data available, over 70 million instruments active and expired from over 500 exchange and OTC venues, with data coverage going back to 1996. So your algorithms you can have a look at all sorts of market conditions, and level 1 and level 2 are available. So let's see what some of this stuff looks like. So we're just going to import. I ran this yesterday, so we can have a look at the markets, UX markets, a snap in near the start of the session. So we just import our Refinitiv data platform library here. A few standard Python libraries. We just put in our API key here, and then we're going to get some data for the E-mini future, the ESC1 continuous future, so which is an example of a full tick venue. This is a level 1 data. So we just here request our instrument, and then some start dates and end dates, and then we can add some manual exchange corrections and manual corrections. And this is what the data looks like. The data is returned to you in a data frame, indexed by date time, and you can see here the sort of milliseconds timestamp here. It's curtailed here. We actually have microsecond and nanosecond timestamps were available, and I think they're nanosecond in the file that I've given you. So here we can see trades and quotes here. So there's a trade, there's a quote, and we have bid size, bid price, bid size, ask price, and you have a load of other fields there. You could, you can see that in in the files that you have. You have a similar kind of thing. So this is 10,000 rows. So this is just about a minute of data. We can see here for this data frame here. So what we can do is just to aggregate this sort of updates at a 1 second frequency using just the resample method for 1 second, and we can just have a count to see how many updates were received in each second, and then basically we can kind of try to graph that. I've just put a small threshold in of 250 updates a second here, and this is just some routines where we could just chart those, so we can make some pretty charts here. So you can see here we've got the ask price, the bid price, and the black dots are trades, and these here are where we are seeing this is 200 updates a second, 300, 400. So we're having burst updates per second near to like 500, and it gets much higher as well. This was just in 1 minute, more or less, not even near the opening. We're really an hour into the opening. So we can see our threshold here. So we do get this kind of clustering of activity here, and then these can be used actually for features in themselves. Also, let's have a look at some level 2 order book data. So it looks similar to the other one here. So we actually have here, this is for Allstate on the New York Stock Exchange. Basically, we can see these L1 prices, and then level 2, and this goes out to level 10 or up to level 25. So you get generally bid price, bid size, ask price, ask size, and so that you build out your order book, to 10 or 25 levels of depth. Okay, so this obviously there's a lot more data going on here. So these are very, very high data consumption kind of thing. And what I just done another call here for Nifty, which is an example actually of a level 1 conflated tick venue. So we have 1 update per second here. And here it's in UTC because it's UTC time because it's coming from our real-time network. But on the file you have, it's already been it's local time with the GMT offset. Okay, so it's again the same kind of information here that you have here, and then again you'll see here we do the same sort of thing, but with you're basically getting 1 update a second here. So I've given you a file of this for 1 year to use in this workshop. So you can see this kind of thing here going on. Okay, so I'm going to be around later anyway. So I think with that sort of brief introduction, I'll hand back to Yves.
All right, I think I need to stop sharing.
Yeah.
So here we are. Thanks, Jason. You see, today we are in the area of data-driven finance. So when I was giving a lecture last year in Miami, somebody asked, when will it come that everything is data-driven? I said, we are already there, right? Data is key. Data is the new oil, and I've heard so many quotes around that. And here's like a first glimpse at the data. So we will see and use this in real time. The data set that we provide is on the server in gzip form, so it's roughly to download 100 meg. And here you see like the columns, also here the head and the tail. So we have roughly 10 million data rows that we work with, and we will focus on the trades, not on the quotes. But I don't need to talk about it here. We rather go here and do the processing, and you see here again the link, the short link to notebooks and resources that we provide. So all the code that I'm going to show is available for you to download. So when you go to the link of the gist, you land here, financial tick data analysis. Again, you find the link to the slides, for example, you find the download link, but in the notebook itself, the first one, this is what I'm going to show now. You see the link, you see how you can download it. There are multiple ways of doing this. It's just one way that I'm showing here, but I think it is a disk efficient place or a way of doing it. So everything is there for you to access, and I have executed the code here just before we got started because the conversion of the date time objects takes so long. So this might take, depending on the machine, a minute, 2, 3. So I didn't want to bore you with that. We first go through it, and maybe I can rerun it. Here, you see, this is the link to the data set. I just use URL retrieve to retrieve it. It's saved in a temporary folder, so I didn't want to put it here in my working directory. Here, I read it from this temporary file, wherever this is, depends on the machine, that's for sure. And I can use Pandas read CSV, also indicating here that this is a gzip file. So I will decompress it on the fly, and once I've read it here, I can then do a cleanup. I could have read it also in an string or IO object here, so do it full in memory, but I think that's fine enough. In particular with today's like fast SSD drives that you have, like the new one, 6 gigs per second read and write. That's fast enough for us to write 100 meg there and to read it from there. Once I have done the cleanup, you see now like the raw info that I've shown before on the slide as a screenshot, and the data itself now has 771 megabytes of data here in this context. You see we have the rig itself, here the domain is market price, date time down to the nanosecond with the GMT offset. Here, type, trade, quote, prices, volume, bid price, bid size, ask size. What follows, I will just focus on the trades themselves. maybe use, for example, volume as a feature. That's the tail end. You see, we get started in August 2019, and we end at the end of August 2020. So we have 13 months worth of data here, 10 million data rows. Here I'm selecting just the trades and focus the columns to daytime price and volume. So we played around a little bit with the daytime conversion. This is well known that this is a pretty costly operation to create a daytime object out of strings here, in particular when you have a data set with 10 million data rows. So you see that's the reason why I executed it first and show you the executed version. It would take here on my machine now 1 minute 37. I don't know. I got a new Mac Mini with a new M1 chip, and the first time I did it, I recall it was like 14 or 15 seconds. I need to revisit that. So here I'm on my Intel Mac, but I need to analyze this further because we got so like high variance of numbers. We use Swifter, and Swifter first worked faster, now it's slower. I don't know, but in the end, once it is converted once, then you have a easy time when you have the conversion and the data frame object is in memory. Right, so I use then the converted column here to set the index, and what I end up with is just like price volume for the trades. And you see from the 10 million data rows where we came from, we end up with roughly 4.5 million data rows here in this. Of course, for the same time frame, right? But we just picked out roughly every second observation in the data set. So when you visualize that, you have these linear interpolations there. So that's a trading day, another trading day, that's the weekend, another trading day, and trading day. So this usually is not, for me at least, when I have a look at this, not too meaningful. But you can easily, of course, with Pandas, so tick data analysis with Pandas, can do the resampling. Label right in general is important last. Drop NA, I use drop NA so that we don't get the gaps in between. And what we end up with here, you see with this data frame now, pretty tiny, 6.3 kilobytes only. This is just now trading day. So we have done quite a bit of an aggregation here, resampling to daily, and this would be like something like end of day data, maybe from other sources. You see the evolution here, it was going up until it crashed, like for everybody else around the world. And Germany, for me, is a German, the S&P, the Dow Jones, FTSE, CAC 40, like everything. Every index had like this dip at the beginning of the pandemic here. It's pretty much pronounced. It's quite difficult for machine learning algorithms to learn something like that, right? This is for me as a quant finance guy, this is where you use jumps to model that, right? You have your diffusion with regular volatility or stochastic volatility, and then you have some probability that a jump occurs, and this is more like here a series of jumps, which is then used for the crash, and then you get back to a normal regime, right? High volatility crash, and this is more like lower volatility trending, upwards trending. When you want to think in terms of regimes, we can discuss this when we apply machine learning in order to maybe gain or generate some insights. This was what Jason was starting with, so generating insights from large sets of data. Right, and here you see like the boiled down version, but the problem remains no matter which bar I resample that, right? So this is end of day, but here I do a resampling to intraday bars, so not like daily, but also not tick. I do a resampling to 1 minute bars, and you see that I then end up with almost exactly 100,000 data rows for my data frame. So I do the resampling for the volume by summing up the volume and take the last available tick price for the interval for the 1 minute bar here for the price information, right? So 100,000, you see this is like the end of day, more smooth. It's like a smoothing average, simple moving average. And here you see the 1 minute bars with intraday dips here. So we discussed this. I don't really know where this dip here is coming from, what caused this, because here it looks pretty much smooth, right? But here on the 1 minute bar level, there might have been some intraday dip, for example. I don't know. And this is the data set that I want to use afterwards. So this notebook is called data pre-processing. So we retrieve the data, we save it temporarily, then I read it with Pandas and do some decompression on the fly. Once we have the tick data in, we sort out or select just the trade data. And from that point on, we can then do whatever resampling, whatever visualization or whatnot. So this is all pretty efficient, apart from this little element where we need to transform string objects to datetime objects. And this is then generating 10 million Python objects that are a little bit more involved from just string information. Yeah, in the meantime, of course, if you have questions, you know where to put them. We have the feed, and I might also need to have a look maybe there's somebody asking, is a good question. I prefer to do the drop NA instead of like having this written through the weekend, right? So here I think it's obvious when I would do a fill NA instead of a drop NA, I would get like the weekends as like horizontal bars. But when you work with end of day data, this is not what you would typically have. Right? When you retrieve end of day data, you don't retrieve, let's say for stock or for here the Nifty futures, you don't retrieve data for Saturday and Sunday. If I do the fill NA, I will have data here suddenly for Saturday and Sunday. And if I do the machine learning, this will behave as if nothing would happen there, right? You would get constant values, let's say Friday close, Saturday close, Sunday close. So you would have 3 times in a row with the fill NA, you would have 3 times the same data, and when you calculate returns, etc., I think this distorts a little bit what is going on there, right? So of course you can do fill NA. I would do this usually when I have, let's say, I have the tick data and I do resampling to 5-second bars, for example, intraday, and there might not be, depending on the market, there might not be a single update even for a 5-second bar. Then, for example, I would use the fill NA because the last available would then be the relevant one to fill in the gaps there. But since we have, and Jason has shown this, we have per second 1 tick on average, sometimes 2. 1, maybe there is none for a single second, but we can pretty sure that for 1 minute bar, we will have at least 1 tick. And I do the drop NA again for the same reason, that I don't want to have like the forward fill for like non-trading hours, non-trading days, etc. Right? So this is so that I get like a continuous time series and not one where we have lots of linear interpolations. This is like how it would look like, right? So the fill NA would simply give me like a horizontal line in this context. Yeah, but I'm not saying that this is the only way you can do it. Depending on your use case, you might opt for another approach here with the processing. But it was a good point that I need to have a look at both Q&A as well as on the feed, because people are posting on.
I'll watch the Q&A. I'll watch the Q&A.
Okay, great. Great. Yeah, that's the data. And again, when I'm done here and I've decided on what I want to use for my resampling or resample data that I want to apply, then I save it and can work with it. So it's also not the resampling to a homogeneous time bar or time interval. It's not the only option that we have. So we could also have a fixed number of ticks that we use for the resampling. We could also try constant volume bars, but since we have here the conflated tick version where we have roughly 1 tick per second, I think constant number of ticks wouldn't change the story that much in this context, right? But again, when you work with tick data, you have quite a few options of how to come up with bars. I think the most natural one for us to visualize or to imagine is like the fixed time length bar, right? So now let's do a little bit of processing here. So this should all work. I'm now reading the data set here. So maybe I show maybe the problem with the data that we have in the sense of this is exactly what we have seen before, the 1 minute bar. So for machine learning, this is like a period where probably there's quite a bit to learn. Then we have this exceptional period here, the crisis, the crash. This large drop from 12,000 to below 8,000 here. And then it goes up again rather quickly, like again around the world. So this is not too exceptional, which will be true for other exchanges as well. But maybe we can try it simply first to learn something here based on the whole data set, which is now 100,000 rows. So here I first calculate the log returns, which I use for a bunch of features, and later on to do the backtesting. I take a window length here for my rolling statistics of 1,000, so it's 1,000 minutes. Since we're dealing with 1 minute bars, I calculate a simple moving average a little bit shorter, just 1,000, and then longer 2,000, but this is just for illustration purposes. I'm not saying that this is like how you should do it. There's no investment advice. It's not like any advice in terms of like that. This is again, this is the wisdom that we have gained over 20 years of experience. You should, if you are interested, you can play around with it and come up with your own ideas and conclusions. So I calculate the momentum, simply time series momentum, rolling window, the average of the log return. The volatility is the same rolling window, but this time standard deviation. I also calculate here rolling minimum values and maximum values. So for me to describe, based on these features, the evolution of the time series over time. And given this window rolling approach, we have quite a few, not the number values. I do drop an A, and my labels are here simply the sign of the return. So what I want to learn in this context is, given the feature values, whether the market goes up or down. So straightforward supervised learning approach. I have a bunch of features. I will also lag them later on. And based on a bunch of features, I have the labels up, down. Up would be +1. And down is -1. So here you see, like, this is the original data, price volume, returns. They are obviously pretty small in the sense of that we are dealing with 1 minute bars here, right? So you wouldn't expect here large movements, even in times of stress. SMA1, SMA2 momentum value also pretty small. This is the average of return. Volatility minimum and maximum over 1,000 periods. You see this is, for example, here not changing, nature of it, and we have the labels data. +1 means we had a positive movement, -1 means we had negative. So the market, the futures price dropped in this context. That's the idea, and here we have the features defined. So I have, you see here, placeholder. I could also say I only want to work with the first 4, let's say, just as an example, and to check whether this has an impact. But here I go with all the features that I've got. And before getting to some AI-powered or machine learning-based prediction, a simple strategy, just to illustrate the context here, I can, for example, use SMA1, SMA2 for one of the most classic strategies: short, simple moving average, long, simple moving average, and whenever the shorter one is above the longer one, I go long, and otherwise I go short here, right? So simply going long and short depending on the constellation between the two. Then my return would be the position shifted by 1 day, because this includes same day data. So I need to do the shift here in order to avoid foresight. Multiplied by the market return. So when I'm long, I get the market return. When I'm short, I get minus the market return. So the performance here is the passive benchmark investment, so doing nothing, just going long, is 1.04, so +4%. and my strategy gained some 29% for every dollar invested. But you see, this is like a little bit of a mixed result, right? In the beginning, it is like losing a bit, then obviously it gets the crash here somehow correct, and then it ends up with this advantage. So, but just this is to have a small little benchmark from the technical world instead of the AI-powered world, where we have, I think, a little bit harder time to understand what's going on in these black box algorithms, right? But that's the way I want to backtest also the other strategies and see what's in there. In all, what you see here, this will be very simplifying in a sense that we, for example, don't include transaction costs, for example. So when I talk about here 1 minute bars with machine learning algorithms, we would see quite a bunch of trades, and this alone might render it inviable because transaction costs would eat up any statistical advantage that I might have in this context, right? So I take now my features, all of them, and do lagging. So here I simply take every feature and lag it by 1, 2, 3 days. Sorry, not days. We're not dealing with end of day data or 1 minute bars, so I lag it by 1 minute, 2 minutes, 3 minutes in this context. And I end up with a total of 27, 3 times 9 features, so 9 features times 3 lags, and this then looks like this. This is the original features data set. These are the labels, and then I have here like mom lag 3, volatility lag 1, volatility lag 2, volatility lag 3, minimum, etc. I think you get the idea here, and you have access to the code that you can play around with it a little bit. So we have what we see here, like data on completely different scales. So volatility is small, returns small, then we have price data, etc. So typically what we would do is do a normalization. And this is what I will do in a minute, because I first do here a split of the data. I create a training data set, 75%. First 75% is for training, and the remaining 25% is reserved for testing the results. So we can also speak of in-sample data for training and out-of-sample data for testing. I have another approach implemented here. I skip over that for the minute with regard to randomized splitting, which many people do, and there are good arguments say you shouldn't do this with a time series, but I think there are also arguments sometimes where you can justify that. But I was saying that we have features on completely different numerical levels, right? Orders of magnitude differences in the data itself. So what you typically do is normalization. For neural networks, Gaussian normalization usually proves to be the best in terms of like improving results. Therefore, I take the trained statistics. Mu standard deviation will be a vector of the means and the standard deviation values from the training data set. And here I do the normalization, both for the training data set and the test data set with the same statistics, because mu and standard deviation, these two vectors, become part of the model. Because I train it on the trained data set, I should avoid foresight into the test data set, so I only have mu and standard deviation from train, and this is exactly what I should use for the test data set as well. So when we then have, for example, a look at, let's say, train hat, we see that now the features here, the lagged features that I'm going to work with, they are on comparable numerical grounding. So not like 10,000 and 0.0001, right? I have also included here feature selection. I jump over this. It's also set to 1 by default here. I simply take all the features, 27, 9 base features, and 3 lags in this context. And let's get started. Simple, with a simple decision tree classifier, nothing sophisticated. Here we got it, maximum depth set to 3, minimum sample split 15, not a big deal because we have lots of data here, I guess. And that's the model that I want to use. You see, I've included here more options. What I don't use, I played around with it, is the adder boost regressor. But random forest classifier, which is an ensemble method, as well as backend classifier, this is kind of interesting to play around with. So here I do the fitting, pretty quick in general for decision tree classifier. That's one of the beautiful aspects. Simple, straightforward, deterministic, and fast, right? And we see here my model score in the training data set, some 52% accuracy. And what I always like to check is the prediction here. So it predicts more short positions than long positions. Here I do the back testing. No shifting is required here because I only work with lag data. Only historical data is used for the prediction. And I see here a wonderful in-sample performance at first sight. And you see it here over the whole period. Again, no transaction costs, etc. This is rather simplified way here. But in sample looks promising, but never fall into like the trap of results that seem to be too good to be true. And most often they are too good to be true. What is the only relevant measure for us here at this stage, we don't have anything else that we can use, is the test data set. Where we say, well, we have trained it, and now we look into the future. We present the model with data that the model has never seen before. And we get here a accuracy score of 50.7%. It's not too different from what we have seen on the training data set, which I would say is first an okay sign. It predicts more downwards movements than upwards movements, also something that we have seen. And we have here a slight edge in this context. So this is not like exceptional, but somehow it doesn't deteriorate. And with regard to the downwards movement, we might, again, we need to recall what data we are training it on. When I go to, here we see it, but this is maybe better. This is what we train it on, right? And then we have this crash here, and then we take the final 25% here for the testing. So we are in a period where the futures prices simply go up, but we have trained it here, including a period where there have been huge drops in the price, and we see this reflected also in the number of downwards movements, the short movements, or the short positions that are predicted. So, nevertheless, here in the crash period, it makes decent gains, and here it's a tiny outperformance. I wouldn't say that I would be amazed by that. Maybe neural networks to the rescue. I use scikit-learn neural networks, so nothing fancy, such as Keras TensorFlow or PyTorch or whatnot. The simple perceptron class here from scikit-learn, also pretty fast in general to apply. I have a very low capacity for the neural network here, so a single hidden layer and just 16 hidden units, among others, just to avoid overfitting, because we all know neural networks, they overfit too easily. And here I do the training. It's slower, obviously, than the decision tree classifier, but still just like a few seconds in this context. The model score in the training data set, not as high as before. Again, lots of short decisions predicted, and the data, the results look kind of similar to what we have seen before, right? So at the beginning, it's not too good, and only when we get into the crash period, it outperforms. But over the longer stretch here on the training data set, not that much happening. On the testing side, slightly better edge here, and this doesn't look too bad, right? So this generalizes better, you can say, on the out of sample data set than the approach with the decision tree classifier. The DTC was like absolutely comparable in sample, but out of sample, the neural network here, the tiny neural network, one hidden layer, 16 hidden units only, this is pretty tiny, doesn't do too badly here on the data set. Before I move on, how much time do we have left actually? So we started like 50 minutes ago, that's true?
Yes, 50 minutes ago, I think.
So we have 11 minutes left, is that correct?
Yeah.
Okay, I only see hearts here, claps. So I consider this to be agreement in this regard. Yeah, so we are using here, based on our resample data, 1 minute bars. We using a pretty simple, straightforward machine learning technique, as well as a little bit more advanced approach of neural networks. I have many more options included in here. You have seen them, but due to time constraints, I cannot really go through it. I want to quickly get back to my slides because I jumped a little bit over the context. In that, one of the major obstacles that algorithmic traders and traders in general are faced with are efficient markets, right? So there are many financial theories that lack empirical support or substantial empirical support. But the efficient market hypothesis has lots and lots of empirical support, meaning that I want to jump down here, that, for example, we shall see later that if the random walk theory, I mean, it's like the precursor to the efficient market hypothesis, is an accurate description of reality, then the various technical and chartist procedures for predicting stock prices are completely without value. So technical chartists, be attentive here. Or a little bit more modern, this was from the 60s, 65 is this paper from. And here a little bit more modern, from the 70s, the market is efficient with respect to an information set F, as if it is impossible to make economic profits by trading on the basis of information set S. So think here in terms of S as our data frame, and it could be impossible, according to this hypothesis, to make any profits by trading on what you find, whatever tools you use, etc., in this information set as or data frame. So I think this is a good analogy, right? So in other words, the best predictor of tomorrow's stock price in a least square sense is today's stock price. So simply have a look at today's futures price, Nifty future, front run futures, and there shouldn't be any value in going backwards in time, exactly what we have been doing now, in order to try to outsmart the markets, right? What you see currently as the price, that's it. There is nothing more to learn. The market knows it best, right? But what I've introduced already in our AI first algorithmic trading is that we can go and have the machine implement the scientific method, doing experiments over and over again. And this is what is pointed out here in the book by Pedro Domingos, the master algorithm. Machine learning is a scientific method on steroids. It follows the same process of generating, testing, and discarding or refining hypotheses. Think back to the 50s, 60s. Finance professors came up with theories. Students needed to learn it afterwards. Practitioners applied it in practice. But here the machine takes over and says, well, instead of like 5 theories per year, I can come up with a million, a billion, 10 billion hypotheses. I test them and see what the results are, and then I can pick and choose. And the machines don't get tired, right? They don't need lunch, they don't need to sleep, and they can, what I have shown before with like simple examples, they can do it on like a constant basis. And if there is something to any type of pattern, here's like some favorite patterns of chartist traders, right? But if there is something in financial data that relates even remotely to pattern and pattern recognition, we can be sure about one thing, that the machines are better, A, at spotting patterns, B, at learning about these patterns, and C, acting based on what they have learned based on the pattern. So in the new world, I don't need to come up with my own rules, code, theories, trading patterns, whatever, and apply data to it to generate signals. And this is what I did, what I've shown before. I just have input data, features, output data, labels, and the machine comes up with the rules, with the code. So this is what people say. This is like programming 2.0, that the neural network is like the code that is generated by the machine itself, right? So I don't need to, again, come up with pattern 1, 2, 3, 4, 5. The machine checks, let's say, 1,000, 100,000, a million patterns, and picks out like the patterns that are good predictors, for example, for going long or short in this context. So I want to jump over that, usually one of the central ones, giving time constraints, but it simply says that finance history was driven by normative economics. People said, this is how people should behave in markets, this is how markets are supposed to behave. And then they came up based on these assumptions with simple, elegant theories. But today, and we have discussed this in the context of data-driven finance, we have a look at the data, we want to figure out the relationships, we have powerful algorithms that we can apply, and maybe there is something better at the end, namely a trained machine learning model that outperforms the elegant financial theories for trading. Here, a book, one of the first to combine finance and machine learning in its title. Now we have, when you have a look at Amazon, quite a few. Mine is one of the more recent editions. And of course, we have powerful technology here in this contact. Yeah, so I have shown you the first examples based on the features, and then I want to, for closing out, and then of course we have time for questions, and we are a little bit around to answer also questions in the breakout areas, I think lounge or what they are called. But in order to overcome maybe the problem with, I go back again to the time series, to overcome the problem here that I say, well, when I train the model just on the first half, let's say, the model probably learns something completely different as compared to when I pick out the middle third here with the crash, or when I train it on just like the final data here, right? So these is what we would call different regimes. And yeah, machines are in financial world, regimes play a role. And one way of overcoming this is, for example, to also do a rolling training and testing. So here, this the name of the game here is rolling prediction. You know the basics already. This is just another approach of implementing the same ideas here. So I have the same data set. I read it from disk. I do a localization of to get rid of the GMT offset here. I prepare basically the same features, so nothing new here. So my preparation is the same. Also, the lagging of the data is the same. And now I define rolling windows, or I don't know if this is the proper expression for what I do. I simply come up with date range object, data index object with weekly slices, where I take the starting point of my data set and the end point. So when I have a look at this, I get like weekly slices here. So 11th of August, this will be for the first available, or the end of the first available week. This always ends on Sunday. The second, the third, the fourth, right? So weekly slices, nothing else. And the basic idea now is, again, I work here with decision tree classifier. I can use a random forest, the bagging, or my MLP classifier here with 12 even only, or 16 is what I had. And the idea now is, maybe with a decision tree classifier, using here, that I do a rolling training and testing. So here I get started at the 12th batch, so 12th week, so that we have already some data available, right? I don't want to get started at the very beginning where I just have maybe only 1 week worth of data for the training. So I say I get started with 12 weeks, then I use this as the first training batch, and I test it in the next week. Then I add the next week, and so forth and so forth. So I'm rolling over, and the training and the testing is done throughout in this rolling way. So here, first 12 weeks, training data set, normalization, fitting, test data set is picked, normalization with the training data, statistics, do the prediction, put this into the overall data frame, and do some reporting. So this, with the DTC classifier, you see works pretty fast, and we see the test scores presented here throughout. Sometimes a little bit lower than 50%, sometimes nicely above 50%. Towards the end, you see it's getting slower towards the end because the training data set is increasing. You see the length of the training data set is increasing over time. I could also use a fixed window, but here this simulates like what a human trader would experience, right? When I have more experience week after week, that I can add right? I don't forget what was happening, let's say last year, maybe half of it, but I learn in incremental fashion, and this is what we do here. So I now have many short positions again. Here I only pick out those where the predictions are non-zero, because with the predictions I initialize it here with 0, and for the first 12 weeks I can't have predictions. This is the number of trades. So this is a problem that I briefly mentioned before. With 1 minute bars and these approaches, we get here 20,445 trades. So probably this leads to transaction costs that are prohibitively high. In that sense, it is here, or we remain on the statistical side of things. When you recall what was said here with the efficient market hypothesis, sometimes this is easily forgotten. Here, a market is efficient with respect if it is impossible to make economic profits by trading on the basis of information set out. So this means that in addition to my statistical inefficiency, I must be able to implement a trading strategy that allows me to exploit the statistical inefficiency in an economic way. Otherwise, this remains like a theoretical endeavor. And frankly, what I'm showing here at this stage is a theoretical endeavor. But we can nevertheless have a look at the results. And you see here with this rolling approach with the decision tree classifier, the performance is, I guess, quite a bit more impressive and also a bit more consistent than what we have seen before. We cannot obviously directly compare what we see here because we have a much longer out-of-sample test period, because we get started with out-of-sample testing after week 12, so week 13. We get started, and so we move incrementally forward. But you see, with this approach, it seems to be even better than the in-sample performance over the long training period. And what I usually have to look at is how linear this is going up. So sometimes you see like weird behavior where you say, well, this was simply luck at the end. But this seems to be, apart from this dip here, apart from this crash period, it seems to be pretty consistently going up. So this approach, I would say here, is promising in terms of overcoming the problem here with that we have basically 3 different regimes in the same data set: low volatility trending, crash, and again low volatility trending. So with this incremental approach, we better simulate what an experienced trader would also do. She would adapt to new market conditions, maybe not immediately from day one, but after a certain period of time. This is then reflected better and better in the model itself. Yeah, bringing me to the end here, to the conclusions. So thanks to Jason and Refinitiv, we were able to work with a relatively large conflated tick data set. 10 million data rows was the starting point. Of course, we crunched it, we pre-processed it to come up with something that we work with. But big financial data, we've discussed this, historical streaming, structured, unstructured, gives rise to data-driven finance, right? I haven't used a single financial theory, no CAPM, no arbitrage pricing, no I don't know, not even the momentum strategies or whatnot. I have simply applied machine learning, deep learning models to the data. So lots of data might indeed be good for the financial domain. We can say that AI is not only influencing areas such as watching shows on Netflix or listening to songs on Spotify, but also autonomous vehicles on the cars and basically every area of our lives. And why shouldn't it influence in a similar way the financial area as well? So from my point of view, and I think many others would agree these days, it can be assumed that the combination of data-driven and AI-first finance will influence and change finance and algorithmic trading for good. This is not something that just popped up. This is simply there to stay. We are also here to stay a little bit longer to answer questions, maybe in the breakout lounge area. Having a seat at the table, Jason for sure as well. I saw already there have been a few questions with regard to data and everything. And no matter what the question, we try our best to answer them, and might go through that. I think Jason, you answered also questions in the Q&A part.
Yeah, I've been answering some questions. There's another one now, which is there any free source to get historical financial ticks in bulk? I've provided some of those things, the conflated feed here today. So in the samples that Yves has used, you can use those in the workshop. And generally, I don't know. I mean, to get high quality data, I think is relatively costly, which is why I think that many people say that this sort of high tick-driven data, I mean, not only is it computationally expensive to deal with at scale, it's also costs money to do that because it's much larger. So you may be able to get some ticks available for free on some feeds. I think Yves uses some in the FX space, I believe. But generally speaking, I think in the industry, they want to pay for very high quality data. That's to make their decisions on. But Yves, maybe you have something to add?
Yeah, I think the major issue usually is licensing issues, that the exchanges license the data to data vendors, etc. So this is typically the obstacle. Therefore, and that's why I'm mentioning it, you usually only get free tick data from trading platforms, in particular in the FX space, such as FXCM, a company we have worked with in the past. So they have tick data that we provide primarily for currency pairs, let's say euro, US dollar. They provide tick data for these for free. So you just need to have let's say a free demo account, like 5-minute sign up. And they get data for euro, US dollar. Then the last numbers that I have in mind is roughly like 2 million ticks for a weekly batch. So this dates back a couple of years. It's not like current. So it might be that you don't get data for free data for the most previous week. But if you are only interested in maybe getting started crunching more and more tick data, for example, FXCM, a company we have worked with, I know they provide it. Not even all. Another company, Wanda, for example, FX trading, they don't provide, for example, tick data. You only get 5-second bars, to name another one. It's there, but rather limited, and quality, of course, is I think with regard to tick data, a big issue.
So I think we don't have any more questions from the audience right now. Thank you, Yves, and thank you, Jason, for hosting the talk, and thank you, audience, for joining the session. Thank you.
Thanks, everybody.
Our pleasure.
In the lounge.
Time for the conference.
Bye.
Bye.